Welcome to Breaking News to Trading Moves. Today, we're looking at a key operational update in the world of regional bank consolidation. Specifically, the announced merger between Huntington Bank shares and Cadence Bank.
That's right. The core news here is pretty simple on the surface. These two banks have cleared a really crucial regulatory checkpoint. They've gotten the approvals they need to move forward.
And for anyone who's tracking the regional banking sector, getting that green light, it provides a lot of clarity. It signals the deal is now very likely to close.
It does. So our mission here is to analyze what this actually means for the trading prospects, not just for Huntington and Cadence, but for, the rest of the industry that's operating around them.
Okay, let's start with the facts then. What exactly happened and who are the players involved here?
So we're focusing on two main companies. First, Huntington Bank shares, that's ticker HBAN. They're the acquirer.
And third,
the target is Cadence Bank, ticker CADE.
Right. And the big regulatory breakthrough was getting approval from the Office of the Comptroller of the Currency, the OCC. For a bank merger this size, that's the big one.
It is. It's the biggest hurdle.
So having this means they now have all the necessary regulatory approvals to proceed.
That's absolutely correct. Regulatory approval, especially in the current environment, is probably the most complex part of any deal like this. Once the OCC gives its blessing, the uncertainty just drops.
Now, even with this clearance, the timeline they've given is still pretty long. They're saying the expected close is February 1st, 2026. Does that long runway, does that introduce other kinds of risks we should be watching? Rate changes, economic changes.
That's a very sharp observation. The deal risk, so the chance of the merger itself being blocked, that's nearly gone. But the execution risk is still there.
Okay.
A timeline that goes out into 2026 means they're exposed to, whatever happens in the macroeconomy. If rates fall fast, for example, the margins they projected might shrink.
Right. That could affect the deal's value.
Exactly. Or if the economy slows down, credit quality becomes a worry. That 2026 date gives them time to integrate, sure, but it also gives the economy plenty of time to change.
So why does this matter to the wider market? Beyond just these two banks, what's the immediate consequence for investors who watch M&A?
It really comes down to valuation and risk. When a deal gets its final approvals, that deal risk, it just plummets. We talk about the spread.
And for anyone learning, the spread is just the gap between the target stock price and what it will actually be worth when the deal closes.
Exactly. And that gap tightens when the market believes the deal is a sure thing. For the acquirer, Huntington, less uncertainty means its stock can re-rate. The market gets more confident.
That makes sense for them. But if we pull back a bit, a clean approval like this, it must also send a message about the current regulatory mood for all regional banks.
It does. The fact that this went through relatively smoothly sends a positive signal. It says the M&A window for regionals is still open, consolidation is still a viable strategy for growth.
And that can help lift the mood across the whole group.
For sure, especially for some of those smaller banks that feel they need to get bigger to compete.
Which brings us to the basic reason these deals happen anyway. Scale. This whole transaction is driven by the need to compete in these high-growth markets where size is just becoming essential.
It is. Scale isn't a luxury anymore. It's a requirement. Think about it in a few ways. First, deposits. A bigger balance sheet helps you compete for those sticky, low-cost deposits that are the lifeblood of a bank.
And technology.
Right. Second is digital infrastructure. Building a modern banking platform is incredibly expensive. You need to spread that cost over a huge number of customers.
And I imagine commercial lending is the third piece.
It is. Bigger companies need bigger loans, and this combination lets Huntington serve larger clients than it could before.
Okay, let's get into the financial consequences then. Who are the winners from this deal moving forward? We've broken down the potential beneficiaries into three clear categories.
The first and most obvious winners are the deal parties themselves. So Huntington Bank shares, HBAN, and Cadence Bank, CAD.
They win because the deal is de-risked. Let's dig into the immediate benefits for them, though.
For Huntington, the approval means they have more visibility on timing. They can plan their integration costs better, and more importantly, know when they can start capturing those synergies.
The cost savings and new revenue opportunities.
Exactly. And for Cadence shareholders, it secures the deal and removes that major roadblock that was keeping the stock from its full valuation.
Okay, so that's category one. The second category of winners would be other regional banks with M&A optionality, right? This creates a kind of halo effect.
It does. Investors start speculating on who could be the next target. And this speculation isn't just random. It re-rates banks that have desirable features, like a strong regional footprint. But maybe they lack the scale of these newly combined players.
So investors are basically betting that the success of this deal could trigger others.
That's the idea.
So let's name some of the companies that fall into this bucket.
You could look at KeyCorp, ticker KEY, Citizens Financial, CFG, First Horizon, which is FHN, and Zions Bank Corporation, ZION.
Okay, let's take KeyCorp, KEY. Why would they specifically benefit from this momentum?
Well, KeyCorp has a solid commercial lending business, but its stock sometimes trades at a valuation that suggests it's not growing as fast as its peers. M&A clarity could boost their valuation just on the idea they might be acquired at a premium.
Or that they might become buyers themselves.
Or that they might get more aggressive, yeah.
What about Citizens Financial, CFG? They're in some of the same markets.
They are, and CFG already has a history of doing smaller acquisitions. When the environment for bigger deals looks clearer, it sort of validates their strategy and gives them better negotiating power, whether they're a buyer or a potential target.
First Horizon, FHN, comes up a lot in M&A chatter.
It does. FHN has a very attractive footprint right across the Southeast, which is a growth market everyone wants a piece of. Their name is on this list because of that simple geographic appeal. They're a prime candidate for a larger bank wanting to get into the Sun Belt.
And finally, Zions, Z-I-O-N, out in the Mountain West.
Zions is a classic example of a big regional with great customer loyalty, but one that could really benefit from the cost savings and digital upgrades a bigger partner could bring. When consolidation is easier, their strong deposit base makes them a very valuable target.
That brings us to our third category of winners, one that people sometimes forget about: the bank technology and processing vendors.
This is almost a guaranteed revenue stream for them. Big mergers mean big mandatory integration spending. It's not optional. You have to do it to combine two large banks.
So we're talking about checks getting written for system conversions, upgrades, making sure everything is compliant.
Precisely. The spending covers core conversions, which is the huge task of moving all the customer accounts to one platform. It covers digital channels, payment systems, all of it. It's a direct, measurable tailwind for these vendors.
Let's list those core tech providers who stand to benefit.
We'd look at Fiserv, ticker FI, Fidelity National Information Services, FIS, Jack Henry & Associates, JKHY, and SS&C Technologies, SSNC.
So Fiserv, FI, and Fidelity National, FIS, they're the giants in this space.
They are. They handle core processing for thousands of banks. So a massive merger like this means multi-year, multi-million-dollar contracts for them, just for the system conversions. Their revenue is tied to the pace of consolidation.
And what about Jack Henry, JKHY, and SS&C, SSNC?
JKHY focuses heavily on community and regional banks, so when mid-tier banks merge, they often get those integration contracts. SSNC is more on the back office side, risk management, software, all things that need to be scaled up after a merger.
All right, let's flip the conversation. Consolidation isn't a win for everybody. If some banks are gaining scale, who's facing new competitive pressures? Who are the potential losers here?
Right, not every bank wins when their neighbors get bigger. We have three categories of institutions that will probably feel the heat.
The first one seems pretty straightforward. Regional competitors that operate in the same areas as the new Huntington Cadence.
This creates a really clear competitive advantage for the new, bigger bank. A larger, combined company has more resources. They can launch aggressive marketing, they can cut fees, offer better prices on commercial loans, and most importantly, on deposits.
And that competition puts pressure on the profitability of every other bank nearby.
It does, and it raises their costs to acquire new customers.
We should name the specific banks that might feel this pressure.
That group would include Regions Financial, ticker RF Synovus Financial, SNV Comerica, CMA, and Truist Financial, TFC.
Okay, let's start with Regions Financial, RF. Where are they going to feel the most direct heat?
RF operates heavily across the Midwest and Southeast. That's exactly where the new Huntington Cadence footprint will be strongest. They're going to face immediate, aggressive competition for every commercial client and every valuable deposit account.
So they might have to accept lower loan yields or pay more for deposits just to keep their customers?
That's the dilemma.
What about Synovus Financial, SNV? They're mostly in Southeast.
SNV is strategically exposed. Their focus on community banking and commercial real estate is exactly what the bigger combined bank will now have the firepower to go after. Synovus will have to spend more just to stay relevant.
And Comerica, CMA, is more focused on commercial clients, right?
Yes, highly specialized in middle market businesses, and that is precisely the type of customer Huntington is scaling up to serve more effectively. It puts Comerica in a tough spot.
And finally, Truist, PFC, which is already a very large player.
Truist itself was formed from a big merger, and they're still working through their own complex integration. Now they have a newly energized competitor who can focus completely on growth, while Truist is still integrating its own systems.
That brings us to the second category of banks facing pressure, the smaller and mid-sized players that now have a bigger scale gap to deal with.
The problem here is that rising technological standard we talked about. Every successful merger raises the bar for what customers expect from a digital experience, and that makes it hard for smaller banks to keep pace.
Basically, consolidation forces them to spend more on tech, which can hurt their efficiency.
Exactly. When smaller banks, which already have higher costs, are forced to spend more just to match their bigger competitors, their efficiency ratio gets worse. Less of their revenue makes it to the bottom line.
And the banks facing this particular pressure would be?
You can look at Bank OZK, ticker OZK, Western Alliance Bank Corporation, WAL, Bank of California, BANC, and Fulton Financial, FULT.
Bank OZK is known for its real estate lending.
They are, and they're very profitable in that niche, but their reliance on that one area makes them vulnerable. They can be outspent on gathering deposits by the new combined bank, which has a much broader consumer business.
And Western Alliance, WAL, and Bank of California, BANC, they're in very competitive coastal markets.
WAL and BANC are dealing with a double threat: fierce competition for deposits and the extremely high cost of maintaining top-tier digital platforms. When a rival gets this much bigger, that cost disadvantage feels even heavier.
What about Fulton Financial, FULT?
FULT has a strong regional presence, but like a lot of its peers, it's constantly weighing the cost of tech transformation against its traditional community banking model. This deal pressures them to spend more, faster.
Finally, we need to talk about standalone regionals that could face margin pressure if this just heats up the competition for deposits across the board.
This all goes back to the net interest margin, the difference between what a bank earns on loans and what it pays on deposits. If these bigger combined banks start paying higher rates to attract deposits, it forces everyone else to raise their rates too.
And raising deposit rates directly squeezes that net interest margin for the whole sector.
Precisely. Banks that rely heavily on core retail or commercial deposits will feel that pressure immediately. They'll also probably have to spend more on marketing just to keep clients from leaving.
The banks feeling this intensified margin pressure would include Fifth Third Bancorp, ticker FITB, and PNC Financial Services, PNC.
Fifth Third, FITB, is a large regional player, and they'll immediately feel the effects of an even larger Huntington franchise operating in their key markets in the Ohio Valley and Midwest.
And PNC, which is a giant in its own right.
PNC, while massive, is always competing with the huge national banks. The success of Huntington Cadence just increases the competition from the next tier down. So now PNC has strong new scale in markets where they used to be dominant, which could increase their overall cost of funds.
That's a very comprehensive look at the outcomes here. We've covered why this matters for risk, the strategic value of scale, and a clear list of the winners and those who are now facing some competitive headwinds. So to wrap up, what's the thought we should leave people with?
I think the thought to leave you with is this. The real cost of consolidation isn't just felt when two banks merge. It's felt by every smaller institution that's left behind. The effort, the money required for a standalone bank to maintain competitive digital offerings and stable, low-cost funding is rising fast. As the giants get bigger, the hurdle for everyone else just to stay even gets higher every single day. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.